Today we're going to talk about seller finance multifamily deals and then exiting out with long-term debt, specifically to smaller multifamily properties, typically under $2 million in proceeds. So I've been getting a lot of calls lately, and I figured I'd address this in a podcast episode or a YouTube channel show. And I've got a lot of borrowers, sponsors reaching out, and they were really good at negotiating a great deal on a smaller multifamily, typically 6 to 20 units. But the question then comes to these deals that are under $1 million, getting takeout financing, long-term debt. When can you get the debt? When will they use new appraised value if the property's only been owned for a couple months? And to answer those questions, we're going to dive into this episode.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And today we're going to talk about seller finance multifamily deals and then exiting out with long-term debt, specifically to smaller multifamily properties, typically under $2 million in proceeds. So I've been getting a lot of calls lately, and I figured I'd address this in a podcast episode or a YouTube channel show. And I've got a lot of borrowers, sponsors reaching out, and they were really good at negotiating a great deal on a smaller multifamily, typically 6 to 20 units. And they arranged seller financing with very little cash out of pocket, and they're usually funding the CapEx or renovation out of their pocket for these transactions. And now they're doing a good job of bumping rents significantly on these properties. Usually these are mom and pop type owned multifamily properties, and so the sellers are motivated to sell it, and sometimes they just like to help the young up and coming real estate investors, and they sell on terms. Sometimes it's for tax reasons too. They might want to do an installment sale or so forth. But the question then comes to these deals that are under $1 million, getting takeout financing, long-term debt. When can you get the debt? When will they use new appraised value if the property's only been owned for a couple months? And to answer those questions, we're going to dive into this episode. And really, here are the basic recommendations. The basic recommendations are as follows. Really, you want to see like a 3-month trailing P&L showing the new occupancy levels at 90% or greater. Now, this isn't stuck in set in stone. So there's a lot of flexibility. And so most likely, if it's under $1 million, we're not going to be doing Fannie or Freddie. We're going to be doing bank or credit union. And bank and credit unions are flexible. And right now I'm seeing a lot with credit unions being super flexible. And so you don't need to have necessarily the 90% occupancy. Sometimes you don't need 90 days of seasoning on that occupancy levels of 90% or greater. Sometimes we can get things done in the 70s. I mean, put it this way, if the deal makes sense, there's a way of funding it. And sometimes, even if you want to kind of rush the process, there's bridge lenders out there that now have a 30-year fixed product. It's not as competitive usually as a credit union, but the rates are pretty good, because in general, terms are very good right now. So there's many options to kind of exit out. But what I would recommend is, and this is kind of geared more towards someone that might not own a ton of multifamily property at the time. So they're up and coming, they're building their portfolios. Get your personal financial statement dialed in on the existing asset that you purchased with seller financing, or maybe it was with bridge funding. A lot of the fix and flip lenders will offer bridge funding now. Document all the funds you put in. So you want to document your closing statement, and then all the CapEx you put in. You want a nice little spreadsheet identifying, what you put in, how much cash was put into each unit, and then of course, on the other side, you're going to want to show, what the rents are tested. So if you're renovating units and then moving rents from $500 a unit to $850 a unit, you're documenting, now you're testing that, and you're now able to get $850 to $900 a unit. You're forcing the appreciation of this property.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
And now a word from our sponsors. Want to save money on your taxes? Cost segregation is a strategic tax planning concept that saves money by deferring federal and state taxes through accelerated depreciation. Get a free benefit analysis today. Please visit costseghub.com for more information on cost segregation and all of our cost recovery services that can put more cash flow in your pocket.
So to kind of circle back is, yes, you don't need a year seasoning necessarily. There's ways of working around it where it specifically looks on the income of the property. And most of the time, these are great fits for credit union and bank partners to fund these type of transactions. So that's what we're looking for. So right now, everybody's so busy. It's taking time to get deals done. Okay, let's set expectations. It's very difficult to close a deal in 45 days, let alone 60 days, or close a deal in 60 days, let alone 45 days. But it's achievable, but you want to have all your ducks in a row. You want to have your financial statement. You want to have, you want to build out, if this is kind of your first deal, you want to make sure you have a detailed profit and loss statement. You want everything easy to read, easy to understand, so we can size the deal up and then figure out, okay, it looks like, based on this cap rate, the value here now, the stabilized value is X. And banks and credit unions on a refinance, 70 to 75% is kind of where the loan to value is going to be. Obviously, it's got to underwrite from a debt service coverage standpoint, which is critical. It's got to have a 120 or better debt service coverage ratio. And obviously, if you're 130 or 140 or 150, that's even better. But that's basically what we're doing to kind of size the deal up as you're coming out. So you should get started with the process of looking for debt early on, because it is a process. And then you at least know what milestones you need to achieve to successfully refinance the property. In theory, getting all of your down payment and all of your CapEx back out, and then you have 25% equity cushion left in the property. The bank or credit union is happy because their thresholds are met. You're happy because you got all your money back out and then some, and you're moving on to the next deal. So bridge or seller finance deals, document your CapEx into the property, put together a detailed personal financial statement with a detailed schedule of real estate owned, because they want to see what your balance sheet looks like. They want to see what your experience looks like. And even if you don't have a lot of multifamily experience, showing them that you have 10 or 15 duplexes or whatever you have, right? That's showing experience that you're able to buy, fix, and manage real estate. So that all helps collectively. And then we look at global cash flow. What the global cash flow looks like against debts. And that's pretty much how a deal is sized up. And then what we do from there is, once we get the basic information, we reach out, we put a package together, we reach out to our lender network, we figure out what would be the best avenue. And we look for indicative terms from a bank or credit union. And then we basically relay those terms to you and say, hey, XYZ bank, this credit union, here's the best two options I think we have at this moment. What would you want to pursue? And then from there, we've completed a full application process. And usually the banks, credit unions, they have their own forms. They have their own PFS you want to fill out. They have their own schedule of real estate. So you got to kind of jump through the hoops, fill them out again. But that's why it's important to have everything ready and available. And then once we do find that right lender, we submit the package. They want tax returns. They want business tax returns on bank and credit union. Bank and credit union debt is typically recourse as opposed to agency debt. These are just things you need to learn. But bank and credit union, they'll do stuff that others won't, and that they fill the void of non-agency type deals, whether it's an experience level, whether it's a occupancy level. That's why bank and credit union is booming right now. They're not putting COVID reserves on like agency debt. You have to have 6 to 12 months of COVID reserves. So in theory, bank and credit union at this point in the game might be the best option, period, for these smaller type multifamily. And then there's a ton of bridge money out there. There's a lot of bridge capital looking to invest funds into multifamily value add deals. So whatever your scenario is, happy to speak with you and give you some feedback and some advice that I have for you. Book a call below. Thanks for watching, and we'll see you on the next episode.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.